Hi, it's Lori Richardson with Cornerstone Home Lending. On Monday, December 19th, wanted to share a chart that I thought would be incredibly helpful to all of us as we gather around with family and friends over the next couple of weeks. We're starting to hear rumblings in the media about some analysts expecting a decrease in home prices should rates continue to rise or rise rapidly. And I wanted to share this chart with you because it's amazing when you take a look at it. Intuitively, what they're thinking makes sense because the cost of a home is wrapped up in the price of the home, but also the cost of financing. And so logic says that if mortgage interest rates increase, and fewer people can afford to buy that home, then we may see demand fall and prices fall as a result. But here's the deal. The last 4 times we've seen a dramatic interest rate increase in the US, that's not happened. So let's take a look. Here's a chart of the last 4 dramatic mortgage rate increases that we've seen in the US, where rates increased more than 1% within about a year on average. So in the early 80s, in the late 80s, in the mid 90s, and then into 2000. Take a look at what happened with home prices during those same periods. If you look at those green bars below, in every single case, home prices increased. And for those folks who are still stressed out about interest rates increasing, here's a look at interest rates by decade in the 70s, 80s, 90s, and 2000s to just kind of help people understand a rate in the 4% range or even in the 5% range is still incredible compared to what we've seen in the past. So as always, we'll have to watch and see, but a decrease in home prices should interest rates increase is anything but guaranteed at this point. And I just thought those charts would help us all make our way through that. A quick look at the economic news. The Fed, as widely anticipated, increased the Fed funds rate last week by 25 basis points or 0.25%, and it had a negative impact on mortgage rates, and they ended the week just a little bit higher. Unfortunately for mortgage-backed securities, Fed officials also raised their outlook for the pace of future rate hikes. And so they are thinking at this point that they are anticipating that we'll see 3 Fed rate hikes in 2017 versus the 2 that were anticipated going into that meeting. And the faster pace was viewed as negative for mortgage interest rates. The economic data that came out along with that, retail sales in November were up, not as much as expected. Both the producer price index and the consumer price index were up for November. And we saw initial jobless claims. It was a great number as well. Came in better than expected at 255,000 claims. The important thing to note there that was the 93rd straight week that we had seen claims below 300,000, just showing that companies are holding on to their employees. So good news there. Reports coming out this week. On Wednesday, we'll see mortgage applications and existing home sales. Thursday, we'll see durable goods orders, GDP, and initial jobless claims. The FHFA house price index and personal consumption expenditure, again, the Fed's favored measure for inflation. And then Friday, we'll bring new home sales, and the bond market will be closing at 2 o'clock in advance of the holiday. So if you have any questions, give us a buzz. If we can answer any questions or do anything for you, we're here to help. 720-200-6868.